Hello and welcome to the IC38 crash course. Over the next few slides, we'll learn the basic words used in insurance, how insurance works, the main types of products, what happens when someone makes a claim, and important rules you must know if you work in insurance. This course is short, simple, and made so you can explain these ideas to anyone. These are the insurance terminologies we'll understand in detail in later slides. IRDA, insured, PPN, insurer, sum assured, premium, nominee, appointee, insurance terminology, ombudsman, consumer forum, grace period, lapse, revival, paid up, mortality, par product, non-par product, term plan, endowment, ULIP, whole life, morbidity, TPA, IGMS, cashless, reimbursement, inpatient, OPD, insurable interest, utmost good faith, indemnity, misrepresentation, claim, assignment, and contract.
General insurance and life insurance terms. 1. IRDA, Insurance Regulatory and Development Authority. Definition: IRDA, now called IRDAI, Insurance Regulatory and Development Authority of India, is the watchdog of the insurance industry in India. How it works: they make the rules insurance companies must follow, ensure fair treatment of customers, approve new insurance products, and monitor company performance. Example: just like a school has a principal who makes sure all teachers follow the rules, IRDAI ensures all insurers follow the law. Exam pointer: remember, IRDAI was formed in 2000, renamed from IRDA in 2014, and operates under the Insurance Act 1938. 2. Insured definition: the person, property, or thing that is covered by the insurance policy. How it works: if the insured person dies in life insurance, or if the insured property is damaged in general insurance, the insurer pays the agreed benefits. Example: if you buy life insurance for yourself, you are the insured. Exam pointer: don't confuse insured, the one covered, with insurer, the company providing cover. Insurer definition: the insurance company that sells the policy, collects premiums, and pays claims. How it works: the insurer promises to pay the sum assured or claim amount if the event covered happens, as long as the insured has paid the required premium and followed policy terms. Example: LIC, HDFC Life, ICICI Lombard are examples of insurers. Exam pointer: insurer equal the service provider, insured equal the customer. Sum assured definition: the guaranteed amount the insurer will pay to the nominee, insured, in case of a valid claim. How it works: in life insurance, paid on death or maturity depending on plan type. In general insurance, paid for actual loss up to the sum assured. Example: if your life policy has 10 lakh rupees sum assured, your nominee gets 10 lakh rupees if you die during the policy term. Exam pointer: sum assured is fixed at the start. In ULIPs, death benefit could be sum assured or fund value, whichever is higher, check policy. 5. Premium definition: the price you pay to the insurer to keep your policy active. How it works: can be paid monthly, quarterly, yearly, or as a one-time lump sum. If premiums stop and grace period passes, the policy may lapse. Example: if your policy's annual premium is 12,000 rupees, you can pay 1,000 rupee per month or 12,000 rupees once a year. Exam pointer: premium depends on age, sum assured, policy term, type of plan, and health status. 6. Nominee: the person chosen by the policyholder to receive benefits in case of policyholder's death. How it works: mentioned in the proposal form at the time of buying policy, nominee gets death claim amount directly. Example: if you nominate your wife in your life insurance policy, she will get the sum assured if you die during the term. Exam pointer: nomination is covered under Section 39 of the Insurance Act 1938. Appointee is adult who receives claim money on behalf of a nominee who is a minor. How it works? If the nominee is under 18, you must name an appointee. The appointee will safeguard the money until the nominee becomes a legal adult. Example: you nominate your 10-year-old son as nominee and appoint your brother as appointee. Exam pointer: appointee must be someone you trust. They will handle money for a minor nominee. What is term plan? A pure life insurance plan that pays the sum assured only if the insured dies during the policy term. How it works? No maturity benefit if you survive the term, unless it's a return of premium variant. Cheapest way to get high coverage. Premiums increase with age. Example: you take a 20-year term plan for 50 lakh rupees. If you die in the 15th year, your nominee gets 50 lakh rupees. If you survive 20 years, nothing is paid. Exam pointer: term plan is cure risk cover. Low cost, no savings. Endowment: a life insurance plan that offers both life cover and savings. Pays on death or maturity. 10. ULIP, Unit Linked Insurance Plan. A life insurance plan where part of the premium is invested in market linked funds and part for life cover. 11. Whole life, a policy that provides life cover for the entire lifetime of the insured, not just a fixed term. 12. Par product, participating policy. Insurance plan where policyholders share in the company's profits via bonuses. 13. Non-par product, non-participating policy, a plan where no bonus is declared, only guaranteed benefits are provided. 14. Grace period, extra time, usually 15 to 30 days, given to pay the premium after the due date without penalty. For monthly policies, grace period is 15 days, and for yearly policies, grace period is 30 days. 15. Lapse, when a policy becomes inactive due to non-payment of premium within the grace period. When premium is not paid in grace period, the policy becomes lapse. Revival, reactivating a lapsed policy by paying the due premium and interest within a certain time. Paid up policy. If premium payments stop after the minimum required period, the policy stays active with reduced benefits. Assignment, transferring ownership or rights of a policy to someone else, like a bank, as loan security. This comes under Section 38 of Insurance Act. Health insurance terms. Cashless medical treatment. At a network hospital where the insurance company pays the bill directly. Reimbursement. You pay for treatment first, then claim the amount from the insurer by submitting bills. TPA, third party administrator, a service provider authorized by the insurer to process health insurance claims. PPN, preferred provider network. Hospitals with prefix rates for procedures agreed with insurers usually offer cashless treatment. Inpatient, a patient who stays in the hospital for treatment for more than 24 hours. OPD, outpatient department, treatment where the patient visits the hospital or clinic but is not admitted. Morbidity, the rate of illness or disease within a population, used in health insurance risk calculation. Now let's understand legal and ethical insurance terms. IGMS, Integrated Grievance Management System, an online platform by IRDAI for registering and tracking complaints against insurers. Ombudsman, an independent official who resolves insurance complaints fairly without going to court. Consumer Forum, a legal body where customers can file complaints related to unfair insurance practices or denial of claims. Insurable interest, you can only insure something or someone if you will suffer a financial loss from their damage or loss or their debt. 30. Utmost good faith or uberimma fides. Both the insured and insurer must disclose all relevant facts truthfully during policy issuance. 31. Indemnity, the principle that insurance should put you back in the financial position you were before the loss. no profit from claim. 32. Misrepresentation. Giving false or incorrect information in the proposal form, which may lead to claim rejection. 33. Claim. A formal request to the insurance company to pay benefits as per the policy terms. 34. Contract. The legal agreement between the insured and insurer, represented by the insurance policy. Now let's understand something important, and you shall remember. 1. Insurance Regulatory and Development Authority of India, IRDA. Remember this full form. 2. In 1993, Malhotra Committee was set up to recommend changes for development of the industry. 3. IRDA Act passed on 1999. 4. IRDA started operation as a statutory body from April 2000. 5. IRDA has been subsequently renamed as IRDAI in 2014. 6. 24 life insurance companies under IRDA. 7. Postal life insurance is not under purview of IRDA. 8. IGMS, Integrated Grievance Management System, Grievance Redressal Mechanism. Concept of life insurance. 1. Known for risk transfer or risk pooling. 2. Purpose. Protection of economic value of an asset. 3. Risk. Dying too early, premature death, and living too long. 4. Insurance is a method of sharing the losses of few by many. 5. Risk retention. One decide to bear the risk and its effects. 6. HLV, Human Life Value, is devised by Professor Hubner, helps to know the insurance need of an individual. 7. Human life is an income generating asset. 8. Insurance is a legal contract between insurer and insured governed by Indian Contract Act 1872. This slide shows it's a simple example to explain risk pooling in insurance, how losses of a few can be covered when everyone contributes a small amount. Points from the slide. Total houses in the village 400. Each house is worth 20,000 rupees. So total value of all houses is equal to 400 to 20,000 rupees is equal to 80 lakh rupees. Number of houses damaged each year 4. These are shown with red X marks in the slide. House 1, 2, 3, 4. Loss per damaged house 20,000 rupees. If one house is destroyed, the owner loses 20,000 rupees. Total annual loss 4 houses into 20,000 rupees each is equal to 80,000 rupees total loss in the village in 1 year. Meaning of plus 20,000 rupees and minus 20,000 rupees in the image. Plus 20,000 rupees is houses that are safe, no loss. They retain their value. Minus 20,000 rupees is the damaged houses. They lost their value for that year. How this relates to insurance? Without insurance, the 4 unlucky homeowners must bear the entire 80,000 rupees loss themselves. With insurance, all 400 homeowners can pay a small premium into a common pool. 80,000 rupees divided 400 rupees equal to 200 rupees each. The pool will pay 20,000 rupees to each of the 4 damaged houses. Loss of few shared by many. Think of it like friends in a classroom. If 4 friends break their school bags in a year, instead of them buying new ones alone, the whole class contributes a small amount so all 4 can replace their bags. Exam pointer. This is the principle of pooling of risk one of the foundations of how insurance works, it also connects to the law of large numbers. The more people contribute, the more predictable the loss pattern becomes. This slide explains what risk means in insurance, the types of dangers, perils that can cause loss, and how all insured people in a group can be exposed to the same types of risk. 1. All 400 house owners are exposed to similar risks. Every house in the village faces the same possible dangers, whether it's fire, flood, lightning, or earthquake. In insurance, we call these common risks. The same event can potentially affect anyone in the group. 2. Types of risks, perils, shown in the slide. The slide lists 4 examples of perils that can damage property. Fire. For example, kitchen fire, electrical short circuit. Flood. Heavy rain, overflowing rivers. Lightning. Storm damage to roofs or electronics. Earthquake. Cracks, collapse, or major structural damage. These are insured perils in many property insurance policies. 3. Definition of risk. Risk equals chance of damage due to perils. In insurance, risk is the uncertainty about whether a loss will happen, when it will happen, and how big it will be. Example, you don't know if your house will catch fire this year. That uncertainty is the risk. 4. Individual sum assured. Each house is insured for 20,000 rupees. This is the maximum the insurer will pay if the house is damaged beyond repair. In our earlier village example, all 400 houses together had a total insured value of 80 lakh rupees. 20,000 introducement 400 rupees. How it connects to the insurance principle. All homeowners share the same risks. This makes risk pooling possible. Because everyone faces similar threats, they can pay small premiums into one pool and help the unlucky few who actually suffer damage. Think of it like a football team. Every player faces the risk of injury. If the team creates a common fund, any injured player can get treatment paid for from the fund. This slide explains the pooling principle, the foundation of insurance. It shows how everyone in a group contributes a small amount to create a large fund that can help those who suffer a loss. 1. Contribution from all members. Here, 400 houses each contribute 200 rupees. This is called the premium. Together, this creates a total premium pool, 400 and 200 rupees, that is on 80,000 rupees. 2. Damage scenario. In a given year, 4 houses suffer damage, shown with red X marks. Each damaged house has a loss worth 20,000 rupees. 3. How the pool is used. The total pool of 80,000 rupees is used to pay each damaged house owner 20,000 rupees. Payment calculation. 4 houses damaged, 1 to 2's 20,000 rupee damage amount, that is a scalable 2 of her 80,000 rupees is total damage, right? This exactly matches the premium pool collected. 4. What this proves. Loss of a few is shared by many. No single homeowner has to bear the full 20,000 rupees loss. Instead, each person's small 200 rupees contribution protects the whole group. Even those who didn't suffer a loss still benefit because they have peace of mind knowing they're protected if something happens to them in the future. Exam pointer. This is an example of risk pooling or principle of contribution in insurance. Shows how premiums are calculated based on expected losses. Links to law of large numbers. Larger the group, more predictable the losses. Scenario. There are 400 houses, each worth 20,000 rupees. Every year, about 4 houses get damaged, leading to a total yearly loss of 80,000 rupees. Policyholders and risk. All 400 homeowners are like policyholders. They face the same kinds of risks called perils such as flood, earthquake, lightning, fire. Sum assured SA. The individual loss for one damaged house is 20,000 rupees. This is the sum assured or claim amount. Risk definition. Risk means the chance of damage from these perils. Risk premium. If every homeowner contributes 200 rupees, the premium pool becomes 80,000 rupees, 200 by 400. This pool is enough to compensate all 4 damaged houses fully. Now, let's understand history of insurance. First life insurance company in India, Oriental Life Insurance, 1818. Started in Calcutta, now Kolkata, in 1818. Mostly served Europeans living in India. Indian natives were not the primary customers at that time. Marked the beginning of life insurance in India. First Indian life insurance company, Bombay Mutual Assurance Society, 1870. Founded in 1870. First company to insure Indian lives at normal rates. This was important because earlier companies charged Indian customers higher premiums. First life insurance company in world, Amicable Society for Perpetual Assurance, 1706, London. Established in London in 1706, a group of people contributed yearly payments into a common fund. This fund paid benefits to families of members who died. This was the foundation model for life insurance worldwide. Nationalization of life insurance. 1st September 1956. LIC formed. Before 1956, India had many small private life insurers. The government merged 245 companies into a single public corporation, Life Insurance Corporation of India, LIC. This was to protect policyholders and bring stability. LIC started operations on 1st September 1956. Origin of modern insurance business. Lloyd's Coffee House, London. In the late 1600s, a coffee house run by Edward Lloyd in London became a meeting place for ship owners, merchants, and insurers. They discussed shipping risks and agreed on coverage terms there. Over time, this evolved into Lloyd's of London, a famous insurance marketplace. National Insurance Company Limited, oldest insurance company in India from 1906, which still exists. Established in 1906 in Calcutta. It is the oldest general insurance company in India, still in operation. Today it operates as a public sector general insurer. Nationalization of general insurance, 1972. Jibna Act 1972. General insurance companies were nationalized under the General Insurance Business Nationalization Act 1972, called Jibna Act. 107 companies were merged into 4 public sector companies: National Insurance Company Limited, New India Assurance Company Limited, Oriental Insurance Company Limited, United India Insurance Company Limited. Insurance Act 1938. First legislation to regulate insurance companies in India. WAZIF, 1st July 1938. First comprehensive legislation to regulate insurance companies in India. Came into effect 1st July 1938. Covered both life and non-life insurance. Still forms the backbone of insurance regulation in India, with many amendments over the years. Contract 1. As per Indian Contract Act 1972, insurance is contract between insurer and insured. This law says that any contract in India must follow certain rules to be valid. Insurance policies are also contracts, so they must follow these rules. 2. Contract, agreement between two or more than two parties. Insurer, the insurance company, and insured, the person buying the insurance. 3. Elements of a valid contract: offer and acceptance, consideration, agreement between the parties, consensus ad idem, capacity of the parties, and legality. Offer and acceptance: one party offers something, the other accepts it. Example: you fill an insurance proposal form, offer, and the insurer approves it, acceptance. Consideration: this means something of value is exchanged. Example: You pay a premium and the insurer promises to pay a claim if something happens. Consensus ad idem, Latin for agreement of the mind. Both parties must clearly understand and agree on the same thing. Example, if you think you are buying health insurance, but the company thinks it's car insurance, that's not consensus ad idem. Capacity of parties. Both sides must be legally able to enter a contract. Example, they must be of legal age, 18 plus, mentally sound, and not barred by law. Legality. The purpose of the contract must be legal. Example, you cannot insure something illegal, like smuggled goods. In short, insurance is a legal promise. You pay premiums, and the insurer promises to help you financially if a covered event happens. For that promise to hold in court, it must follow all the rules of a valid contract. Principles of insurance. 1. Principle of utmost good faith. Uberima fides. Disclose of all material facts which influences the decision of prudent underwriter at the time of assessing the risk of an individual. This means both you and the insurance company must be completely honest. You must share all important information about your health, habits, property, or anything that can affect the insurance risk. The insurer uses this information to decide if they will insure you and at what cost. Example, if you smoke, you must tell the insurer. Hiding it can cause problems later. They will involve breach of utmost good faith, non-disclosure, and misrepresentation of material facts. Non-disclosure, not telling something important. Example, you don't tell the insurer that you have a heart condition. Misrepresentation, giving wrong or false information. Example, you say you don't have diabetes when you do. Number 3. Principle of insurable interest. For whom you can take insurance. You can only insure something or someone if their loss will cause you a financial loss. This ensures you have a genuine reason to insure, not just to make money from it. Number 4. Insurable interest, pecuniary, financial, should be present at the time of inception in life insurance, at the time of claim in marine insurance. In life insurance, you must have an insurable interest when you start the policy. Inception. Example, you can take insurance on your spouse because their loss will affect you financially and emotionally. In marine insurance, ships, cargo, insurable interest must be present at the time of the claim. Example, if you own cargo when it is lost at sea, you can claim. Number 5. In non-life insurance, it should be present at the time of inception and claim. In general insurance, like motor, fire, health, insurable interest must be present both when you start the policy and when you make the claim. Number 6. Insurable interest is present in self, husband-wife, parent-children, creditor-debtor, and employer-employee. Self, your own life or property. Husband-wife, spouses can insure each other. Parent-children, parents can insure children and vice versa. Creditor-debtor, a lender can insure the life of a borrower for the loan amount. Employer-employee, employers can insure key employees. Number 7. Principle of indemnity. Indemnifying the loss or compensated up to the amount of loss. Applicable for non-life insurance only. This means the insurance company will compensate you for your loss but not let you make a profit. They will pay only up to the actual loss amount or the sum insured, whichever is lower. Applies only to non-life insurance. Motor, property, health. Example, if your damaged bike repair costs 20,000 rupees but your sum in types of insurance products. 2 main risks in life. 1. Dying too early. Risk. If a person dies before completing their financial goals, like paying off loans, children's education, solution. Death benefit. A payout to the nominee. Product. Pure term assurance plan. Provides only death benefit, no maturity benefit. 2. Living too long. Risk. Outliving your savings and facing financial difficulties in old age. Solution. Survival benefit. Payment if the person survives till the end of the policy term. Product. Pure endowment plan. Pays only if you survive the term. Intangible product. Insurance is not a physical item, it's a promise or contract. Transactional product. Like bank deposits where you deposit and withdraw money. Contingency product. Life insurance pays when a specific event, death, or survival occurs. Wealth accumulation product. Investments like shares, equity for growing money. Best time for financial planning. As soon as you start earning first salary. ULIP death benefit. Higher of sum assured or fund value. ULIP investment risk. The policy holder bears the investment risk. Householders insurance covers gold and silver ornaments. Type of products, traditional products and non-traditional products. In traditional products, it comprises of 1. Pure term assurance term plan. 2. Endowment plan, both maturity and death benefit is payable. 3. Money that plan, SA is paid on a regular interval as survival benefit. 4. Whole life plan. In other side, in non-traditional products, it has ULIP is Unit Linked Insurance Plan UK and Variable Life is Universal Life Insurance USA. Term plan 1. Only death benefit, no maturity benefit for customer. 2. Maturity available in case of drop. 3. Advised for those who has a low budget. 4. Cheapest and low cost plan available in the market. 5. Can be converted to a whole life policy. 6. 3 types of term insurance plan: level, increasing and decreasing term insurance. 7. Mortgage redemption insurance (MRI) is a decreasing term assurance policy. Premium will remain constant. 8. It provides financial protection for home loan borrowers. Keyman insurance. The sum assured under the policy linked to the business profitability by the key employee till his or her tenure. 2. Premium is paid by the company. 3. In case the insured dies, benefits are paid to the company. 4. Who can be a keyman? A key person can be anyone directly associated with the business whose loss can cause financial strain to the business. 1. Health insurance deals with morbidity. 2. Morbidity premium is higher than mortality premium. 3. Hospitalization of 24 hours as inpatient required to cover the expenses. 4. 15 days to process proposal form. 5. 15 days for submission of documents from discharge to claim the expenses. 6. Critical illness policy. Sum assured paid on diagnosis of disease. 7. Employees State Insurance Act (ESIA) 1948 for sickness, disablement, maternity and death of employee. 8. Impersonation. The person taken health insurance is different from person treated in hospital. 9. Critical illness riders. Waiting period is 90 days. 10. Pre-existing disease. Waiting period 48 months. 11. Health insurance claim. Covers 30 days pre-hospitalization and 60 days post-hospitalization cost. 12. TPA. Third party administrator helps in cashless treatment, else have to reimburse the cost. 13. PPN. Preferred provider network. 14. Case paper maintained at hospital on detailing all treatment done to an inpatient. 15. No claim bonus if a person does not prefer any claim in a health insurance policy. 16. Domiciliary hospitalization. Minimum 3 days treatment at home required to claim the expenses. 17. CHC Community Health Center for every 1 lakh population should have at least 30 beds, 1 operation theatre, X-ray machine, labour room and laboratory facilities with 4 specialists and 21 paramedical and other staff. Documents. 1. KYC, Know Your Customer. 2. Standard age proof, passport, PAN card, birth certificate, baptism certificate, school leaving certificate, defence ID card. 3. Non-standard age proof, ration card, horoscope, voter ID card, village panchayat certificate. 4. The Prevention of Money Laundering Act 2002 came into effect from 2005. 5. Money laundering is an offence and punishable imprisonment from 3 to 7 years and fine up to 5 lakhs. Policy condition. 1. FPR, First Premium Receipt. The FPR is the evidence that the policy contract has begun. 2. Grace period, 1 month or 31 days after the due date. 3. Revival, the process to enforce the policy which lapsed or terminated due to non-payment. 4. Deaths during grace period, paid total claim amount after deducting the unpaid premium. 5. Lapse, premium not paid during grace period, insurance cover ceases. 6. Policy document, 4 parts: schedule, standard provision, specific policy provisions, claim procedure. 7. Conversion, a term insurance plan can be converted to a whole life plan. 8. Free look period, customer can cancel the policy within 15 days from receiving of policy document if he finds that the term and conditions are not what he wanted. Underwriting. 1. Risk selection and risk pricing. 2. Proposal form. Underwriter collects data to assess the risk and is the basis of insurance contract. 3. Substandard lives. Risk is higher than standard lives. Extra premium will be charged. 4. Preferred risk, where the risk is lower than standard lives. 5. Insurance on pregnant women. Acceptance with a restrictive clause, lien. 6. Agents are called as primary underwriter. 7. Hazard, physical, moral and occupational. 8. Types of underwriting. Medical underwriting and financial underwriting. 9. Decision on the proposal has to be made within 15 days. MWP Act, Married Women's Property Act 1874. 1. Trustee will get all benefit of the policy. 2. Beyond the control of creditors, court attachments and even the life assured. 3. Not allowed nomination and assignment. 4. Beneficiary under Section 6 of MWP Act, wife alone or wife and one or more children, jointly or one and more children. 5. If no special trustee is appointed, amount goes to official trustee of the state. 1. Claim is a demand, where insurer keep their promise. 2. As per IRDA, death claim will be settled within 30 days from receiving of documents. 3. For investigated claim, 180 days in case of early death within 3 years of policy. 4. Delay of settlement. Interest on claim amount 2% above bank rate paid to nominee. 5. Inquest report, mandatory for accidental death claim. 6. Presumption of death. Missing for 7 years, Indian Evidence Act 1872. From the date of court decree. 7. Insurer has to ask for any additional documents within 15 days. 8. Death due to suicide is covered after 1 year, 365 days. Nomination and assignment. 1. Nomination. Section 39 of Insurance Act 1938. 2. Nominee can be one or more. 3. Appointee required if nominee is minor. 4. Nominee has no full rights on the whole of the claim. 5. Assignment. Section 38 of Insurance Act 1938. 6. Two types of assignment: absolute and conditional. 7. Assignment means transfer of right. 8. Nomination stands cancelled once policy is assigned. Insurance Ombudsman. 1. Ombudsman works in territorial limit. Ombudsman's limit up to 20 lakhs. 2. Complaint can made within 1 year of rejection of claim by insurer. 3. Complaint has to made in written. There is no fees to file complaints. 4. The award should be made within a period of 3 months, 90 days. 5. There are 12 Ombudsman offices in India. 6. Insurer have to honor the award within 15 days. 7. Complaints cannot be made to Ombudsman if the complaint is pending in any court or consumer forum or in arbitration. Consumer Protection Act 1986 COPA. Consumer Protection Act 1986 COPA has been amended by Act 2002. Insurance claim amount up to 20 lakhs district forum. Insurance claim amount more than 20 lakhs to 100 lakhs, state commission. Insurance claim amount above 1 crore, 100 lakhs, national commission. Who buy products for resale purposes is not a consumer. Complaints has to be made within 2 years from the date of dispute. Insurance agents. 1. Qualification. 10th for rural, less than 5,000 population area, and 12th for urban area. 2. Online training requirement of 25 hours. 3. License validity is 3 years, issued by IRDAI. 4. Appointment letter dispatch within 7 days. 5. Issuance of appointment letter 15 days. 6. Communication on refusal of appointment 21 days. 7. Penalty in contravention of provisions, maximal 10,000 rupees. In the case for insurer, it is maximal 1 crore. 8. Appointment authority, designated official. 9. CASA agents are not regulated by IRDA. 10. Section 41. Prohibition of rebate. Fine 500 rupees if agent sharing the commission. 11. Fee for renewal of license 250 rupees.